My favorite index fund, the one that's been consistently outperforming the S&P and is the main reason my overall portfolio has been able to beat the market, is FSPGX. FSPGX is Fidelity's large cap growth index fund that tracks the Russell 1000 growth index. So the Russell 1000 is the 1,000 largest companies in the US, and this index sorts them based on style factors. They give each company a growth score and a value score. If the company skews strongly in the growth style, then it gets placed in the Russell 1000 growth index. And if it scores strongly in value metrics, it gets placed in the Russell 1000 value index. So the way they classify this is growth stocks are companies that show high earnings growth, reinvestment over dividends, dominant market position, innovative pipeline, and higher valuations. These are typically sectors like tech, consumer discretionary, and communication services. Factors they look for when classifying value stocks are low price to earnings ratio, low price to book ratio, high dividend yields, and stable or mature earnings. The biggest sectors in value funds are financials, industrials, and healthcare. So because of this, the growth fund is typically a little more volatile and moves more aggressively than the S&P 500 does. Because the S&P is just the top 500, it's going to factor in both growth and value, which makes it more stable. All right, let's take a look at the holdings. There are about 400 total. Most of the top 10 companies are the same as the S&P 500, but they are much more concentrated, making up almost 60% of the fund. Now, the reason for this is because it's excluding value stocks, but still weighted by market cap. So these companies have huge market caps compared to the rest of the fund. Just the top three, Nvidia, Microsoft, and Apple, make up 35% of the total. Obviously, for the sector breakdown, tech takes up a massive chunk. Consumer discretionary and communication services also have a solid portion. The expense ratio is 0.035%, the same as FSMAX, just 35 cents a year for every $1,000 invested. Now for the returns, over the past 25 years, FSPGX has had stretches of significantly outperforming the S&P. You can see the best year's return was 14% higher, and then for the worst 3 years, it did perform worse, but still within 2%. It's been consistently outperforming the S&P over these stretches, ranging from 1 to 8% better with these timelines. The most recent bear market did cause it to drop harder by about 6%, and then fairly even returns over the lifespans, but keep in mind these aren't exactly the same starting years, as you can see. That performance is a key reason I allocate the remaining 40% of both my accounts to FSPGX. While it typically underperforms the S&P 500 in down years, it tends to recover very quickly, and during strong market periods, it can significantly outperform the S&P, particularly in recent history. This combination of resilience and upside potential is the reason I tilt my portfolio towards large cap growth. Also, just in general, I feel most comfortable with large cap growth for the long term. These huge companies like Apple, Google, and Microsoft give you stability because they're so well established in the market, but focusing specifically on growth also helps you capture those higher returns over time.